And joining me now is Samantha LaDuc, founder of LaDucTrading.com. Samantha, welcome back to the Business Briefing.
Thank you so much.
Samantha, I've had so many guests on my show over the past week who have really had divergent opinions about whether the Fed needs to continue raising rates or not. Do you think inflation at this moment in time is still so sticky that it warrants continued rate increases?
I actually think the Fed is trapped, and that's been a mantra for a while. So basically the past year, as inflation has been sticky, but it's the old kind of whack-a-mole worry that as they get into the end of this tightening cycle, which they're not there yet, then it will simply just reignite the animal spirits of inflation. But the reality is right now we have been in a decelerating inflation since the June CPI peak of 9.1%. We're now about the 6%. And this kind of the next four CPI prints are expected to continue to decelerate. So we already had actually Powell February 1st mentioned the word disinflation, and we've got more evidence of that. So I think that they are right now facing a little bit of a continued weakness, if you will, and confidence over the banking crisis, and they should stop the hiking. One more and done. But they're trapped because as they have already overshot, they are basically in a situation where the inflation expectations will percolate higher when their tightening regime ends.
So, let's talk a little bit about what's happening overseas. Of course, the Bank of England, the Euro area, continue to raise rates despite having a little bit of tension in their banking sectors as well. To what extent are the Fed's actions, do you think, being informed by what's happening with the Bank of England and the Euro area?
No, I think it's very much the Fed makes the weather, and their dovish or hawkish bent is going to make others need to play catch up, not the other way around. But I think very much the banking crisis is helping them to kind of put those tightening constraints into the U.S. economy, which is helping with disinflation to kind of reaccelerate. This is definitely going to put some downside risks to growth here and spending, all introduced by the banking crisis. We can already see that over in the Eurozone area as well, to their downside in growth and spending from their own banking crisis. But their inflation kind of followed ours. So now we're ahead. In other words, we're ahead in getting that kind of disinflation or deflation impulse is what I called it basically for clients. And with this increased deposit outflow also from banks, that will put even more pressure on this disinflation or deflation impulse. So right now, the banks are kind of helping the Fed to tighten, but big picture, they're not done. Typically, the Fed ends its tightening cycle once real Fed funds rates go positive, and currently, those real Fed funds rates are approximately negative 1%, 1.2%. So when we see that switch, we'll know that they're done.
I wanted to talk to you a little bit about Silicon Valley Bank's remnants and First Citizen Bank's acquisition of part of those assets. I thought it was a little bit underwhelming, that they couldn't find a better buyer and so forth. What does it say to you about the state of the regional banks? Because obviously it was kind of a bit of an autopsy on Silicon Valley Bank's overall financial position, and it wasn't pretty.
Yeah, I think it's less about the balance sheet, honestly. Or even the risk management. Those are really great scapegoats to go to, but lots of banks have unrealized losses on their balance sheet. It's only when they become realized. And when they become realized, it's typically from a liquidity event, meaning in the case of Silicon Valley Bank and others of late, it is a request to get out. So it's the bank run. So psychology changes the market dynamics of a going concern from solvent to insolvent. So if there had not been the bank run, they would still be solvent. They could have found another way around the mess, okay? Their concentrated risk, their unrealized losses, all of that would have been resolved much better without yelling fire in a theater. So that's ultimately what created the insolvency. And we still have that issue, by the way, with lending standards, set to be tightened, and funding markets right now a little bit frozen, largely inactive, from commercial mortgage-backed securities to, just REITs and banking, lending in general. There are fears right now that are still gripping the market that we'll have a series of bankruptcies, and not just in banking, but across multiple industries. So until that kind of risk premium comes out of the market, we're going to stay in a heightened level of awareness. So, complacency no more. And equities right now are kind of not, NASDAQ in particular has kind of priced in this loose monetary policy, but it has not unwound that risk premium, basically, that has been put into the market, that we have more trouble brewing. And I think that the deposit outflows are evidence of that. We continue to have like 125 billion drained from U.S. small banks in 1 week. So the outflow continues. The worry will continue until that calms down, and more likely an accident is waiting to happen instead.
So, let's talk about other sectors of the economy. And, a lot of focus has been on commercial real estate and some of the realized and unrealized losses therein. Is that the next shoe to drop? Is it something related to commercial real estate, or what sector of credit do you think is most concerning at the moment?
The credit spreads are definitely starting to widen, which not in a percentage term that makes the credit markets weary, but you can see fixed income having wide volatility in its rates movement. Most definitely, commercial MBS market has been frozen for a while, which is worrisome because those unrealized losses, again, like a bank run, only get realized when there has to be a liquidity event. So right now it's kind of hidden or quiet, but now it's becoming much more aware. So there are definitely conditions that it's ripe again for that kind of accident to happen in the short term, as this whole renewed risk in the CMBS market pulls forward the increased cost of borrowing money and the decreased bank profits and decreased lending that create the fear of recession and pulls that risk forward. So it's definitely there. It has been there for a few years during COVID and the work from home, mobility movement. But that it has been, again, kind of a quiet monster that is now starting to get a lot of attention. And that is the psychology of markets, right? We really, really have not to worry about a crash until the investors demand their money back. And that could be for insurance policies, bank deposits, et cetera. So that's actually what we're dealing with right now, is this risk premium in the market of waiting for the other shoe to drop, and what will pacify markets to kind of like, let's go focus on earnings, which are coming up, right? So.
Yeah, earnings concern me, absolutely. But this conversation that we're having is actually a fascinating one, because when I think about the Fed's backstop of the banking system that's been enacted, people talk about the moral hazard implicit therein, but without that moral hazard, then the animal spirits would not have been calmed, and you would potentially still be having these runs on the regional bank.
Correct.
Is there sort of a counter-cyclical approach that can be taken, I think, longer term to sort of quell these cycles? Because it seems to be a cyclical thing, right? Like people get scared, and then the Fed, the Treasury steps in, there's some sort of backstop, and then, they need to keep supplying that backstop until the animal spirits calm down again. Sure, regulations are one thing, but is there anything else that needs to be done to sort of stop this to and fro cycle that tends to occur every decade or generation or so?
Well, very much so. Price discovery needs to actually be allowed again. So the Fed and Treasury have basically, in a nutshell, depressed risk premiums. They have suppressed volatility. They have depressed risk premiums. This is not an environment of true price discovery. So you don't know what your house is worth because they have bought mortgage-backed securities. So the point is, we have no a way to tell what the real price of equities, let alone bonds, let alone housing, should be because of this intervention, this continued intervention. And we won't until there's obviously...
I mean, there's no way to unwind it, right? I mean, it's too massive to unwind completely at this point. I mean, I don't see how we ever return to real price discovery, barring some sort of catastrophic event.
Well, it is not. It doesn't have to be all or nothing. They did start out. I should say, Powell did try in 2018, right, to start hiking again. That was completely unwound at Trump's behest. But this emergency type of backstop, whether it be the banks and most recently, right, on March 12th, and then, of course, NASDAQ smelled that lovely loose monetary policy and ran higher with Bitcoin and gold, or the intervention that occurred back in the lows of October in the markets in general, both bonds and stocks, and $1 trillion of central bank intervention came in between the U.S. Treasury, Fed, Bank of Japan especially, China, Switzerland. There was a coordinated effort. So they have, again, a system also through U.S. dollar swaps, which help this whole system stay stitched together. So they have a debt, massive amounts of debt, which is the stock market, kind of a mantra of mine. U.S. government debt is the stock market. So as they unwind that puts pressure, obviously, on equities and bonds to fall. They've been basically doing it with controlled demolition, but it is on its way down, meaning it has. We hiked up the mountain, and now we're hiking down. So it is hopeful that they can still maintain control as we hike down the mountain. But they are trying to unwind some of these excesses. We saw a lot of that last year, right, in 2022. Very large crash in bond, largest historic bond crash, but also in equities. So we still have more work to do. That's the work that they're trying to do slowly without impaling our lovely market returns and economic health as well. So there's going to be more of this, not less. But for right now, we are in a little short-term deflation impulse. The bank crisis has pulled that forward. Earnings recession, we're not really at the trough of it. Normally, we have like a 23% decline peak to trough. Right now, we're only at best, a negative 7%. So we still have another quarter or two to go before we really, maybe even 3, before we really feel the recession in earnings. And that's a better place to be adding risk, not here.
All right, Samantha, tell us where we can follow you and learn more about your work.
Oh, thank you so much. Yes, I'm the founder of LaDucTrading.com, and I also can be easily followed on YouTube. We have a channel as well as Twitter at Samantha LaDuc or LaDuc Trading channel on YouTube.
Excellent. Thank you so much again for joining us. A pleasure as always.
Appreciate it, Janet. Bye-bye.
And Samantha LaDuc is president and founder of LaDucTrading.com.